in terms of margin. Can Tesla maintain the margin with the growth? And BYD has been spoken of as this great competitor. It's eating Tesla's lunch, blah blah blah. I think this quarter kind of blew that out of the water. Although one quarter is not. Although BYD has come out from nothing in the last year. It's been a very focused effort on their part, very strategic, very impressive. But if you look at them, they're earning a gross margin of 17% to Tesla's 25% for this period of time. So Tesla's margin is 50% more than them. But look at the net margin. This is amazing to me that they can eat 13% of their revenue in operating costs, compared to Tesla at 8% of their revenue in operating costs. I just don't see the growth coming.
Yeah, this is Zach Kirkhorn's big pitch for don't just look at our gross margin, look at our operating margin. And Tesla finds all kinds of they don't just innovate in manufacturing vehicles, they innovate in running the business. And dramatically successful. And I just want to say, by the way, I'm rooting for BYD to succeed.
Yes.
I think the world is a better place if there's at least one other significant EV maker. And I think when we talk about the market share, one of the reasons that Apple was able to grab so much market share and Android was able to grab even more is because the other makers disappeared. There's a certain point where some of these companies are going to die. And when they die, that's more market share available.
Yeah, and I'll talk about what I think. The one thing that I will say is that everybody, and I'm always on Gary. I kind of give him a hard time, but he talks about getting to 75% or X% of the market being electrified versus or 60%. I think is his number. I think at a point in time it just dies completely. I don't think it goes, step by step by step by step by step. I think it goes step by step by step and then bang.
But the overwhelming focus is solving full self-driving. So, yeah. And that's essential. And that's really the difference between Tesla being worth a lot of money and being worth basically zero.
Yeah. Some of the pundits, the experts there were telling me that Tesla is in trouble in China. However, think about it this way. If NIO is losing $19,000 per car and Tesla is making $9,574 per car, then that's a $30,000 disparity. And we all know that Tesla in the past has made more on their car sales per car in China than anywhere else in the world. It's possible Tesla was making more like $15,000 per car in China. They have a huge advantage over NIO, over XPeng. Yes, it's true. I've heard the criticisms. They don't have enough models. Not enough models, therefore their sales are in trouble. Sometimes what's more important than models is staying alive, staying in the game, continuing to make money while your competitors lose it. Speaking of competition, there's one last competitor here that we need to talk about, General Motors. General Motors make a profit. It's actually pretty good. Best in the legacy industry right now, $2,150 per car. Now imagine if General Motors weren't spending $1,000 per car on marketing. Their profit per car would jump by an incredible 50%. 50%. That's one of the key advantages that Tesla clearly have. Not spending money on marketing. Now, it doesn't really work well for me. I wouldn't mind if...
A reason why that's not true. Plus, sort of my own math says that their net margin after selling through all their cars at scale should be somewhere above 20% or around 20%, which implies that if they aren't able to hit 2 million car production for whatever reason at current prices, you still got a lot of room. You still have technically 20% margin to give up if you wanted to run a break even, since your company doesn't have any debt. Now, from a standpoint of a shareholder, you probably don't like that answer because you're like, well, where did my earnings go? But I'm more afraid for everybody else if that were to happen. Because if Tesla says, okay, I need to get to full production and I need to crank out 2 million cars per year, and 20% margin ain't going to get me there. I need 10% margin. That implies another 10% price drop somewhere, or probably more, because your economies of scale will kick in at some point as well. And you also assume if the economy has slowed down to a point where you have to lower the prices that much, the supply chain should be in deflation as well, and you'll be able to strike new deals with your suppliers and new contracts at a lower price for higher volume, right? So there's a lot of variables that kick into this. And all of it just seems like the company with the most pricing power wins. The one that has all the margins to be able to sell through wins. The one that can pass through these directly to the consumer without getting gouged at the dealership wins. The one that has the least amount of friction and barriers to get the car wins. The one that can upgrade their software and charge extra money for those cars wins, right? There's all these variables that are pro Tesla in this environment versus legacy. So I might be naive in thinking that 2 million is the bottom for 2023.
Wind up at the end of the day with about 3 or 4% net profit. How much does Tesla make in net profit? Take a wild guess. If you're less than 20%, you're a fool. You don't know what you're talking about. That's the starting point. Now you go on top of it. So when I said that Tesla could cut their profits in half and still make more money than any car company on the planet, I am not kidding you. And if you don't believe that, ask the guys over at VW with the ID4. The ID4 now is $4,000 more expensive than a Model Y. Who in the hell is going to buy the Model Y? Who's going to buy an ID4 if I can get a Model Y with the best charging systems on the planet, with all the right things going for it, with the fact that they're probably going to beat everybody to full self-driving eventually, and
improving quarter over quarter.
So I would square it up by saying I think margins are going to improve in the back half of the year. And if I'm wrong by a quarter, they're likely improve in 2024. And the reason is that they are ramping production at Austin, their 4680 battery, which has been a drag on margins. We've talked about lithium prices going down. That benefits Tesla more than it benefits Ford and Giga Berlin. And so that's my base case. Agree that facts are the facts. Margins have been down, but I think that they will rally back here, back half of this year into next year. And as far as the margins and the impact, I think this is a critical topic, which is traditional auto is getting smoked right now when it comes to EVs. Ford, they break it out. They lose 40% in their EV division. Polestar, half owned by Volvo, 45%. Tesla makes about 15% operating margin. My case is this. What you just described, Dan, that's going to be the world of traditional auto. I think they're going to continue to have struggles to.
Let's look at that next slide. Because what I've done is I've taken, some, not all, but some OEMs and compared their return on assets. And the difference, it is staggering.
Wow.
The only company that's even close to Tesla's class, even close, is 17% below Tesla, but it's close, is Ferrari. Who will sell you a handmade car if you line up and wait for 2 years, for your car and pay $400,000. And they make 13% return on the assets compared to Tesla's 15 plus. And by the way, that wasn't their best quarter either. That included, the first and the second quarter of this year.
Yeah.
Look at Mercedes. And then you start going down the line, and where does Ford sit?
Yeah.
Right at the bottom, earning 10% of what Tesla is earning on their assets. Where are they going to get the money? Look at GM. GM is almost respectable at literally a fifth of the profitability of Tesla. The scope of this is just staggering.
Well, there's just lots of bizarre things that now that he's gotten to be as big as he is, have to keep happening for the stock to still be worth 10 times revenues, which is where it's trading. And with monster margins, its margins are just unheard of. But when you sell a product for $15,000 that doesn't exist, like full self-driving, it's pretty good for margins.
Are they getting high prices for their cars, but they're selling a product that doesn't exist called full self-driving. Full self-driving was released in 2016 at $6,000. It's still now in beta tests 6 years later. They're charging $12,000 for it. The take rate is not 100% certainly, but that's all profit to Tesla. And it helps their gross margins dramatically, number one. Number two, at $1 trillion or plus, $1.1 trillion valuation, not only do they is the market cap equal to the entire rest of the global auto industry, and that's been the case for a while, but it's really implying that the 50% unit growth is going to have to continue. I think I mentioned that the last time I was at your shop, and so far it has. But the problem you have is that you have the law of large numbers. The company is supposed to have about a 500,000 run rate of deliveries in the fourth quarter of this year. So that's a 2 million unit annualized. In 2 more years, it's supposed to be 4 million. Just to put that in perspective, the total volume of luxury cars pre-pandemic, $50,000 or more globally, was 2 million units for ICE and EVs. So the street is assuming right now that he will basically be doing 200% of all luxury cars sold globally in 2024. And then it gets worse from there. And so that's the problem this stock has, is it has the law of large numbers. It's got the Cisco problem. Cisco got to an insane valuation in 2000 because everybody put their hopes and dreams on it, even though it was still just making routers. And it was going to be this, it was going to do that, it was going to get into fiber, it was going to do all kinds of things that they never really did. But they never really missed numbers either. And yet the stock went down 80% from 2000 to 02 and is still not back to where it peaked in 2000. And I think that's going to be Tesla's problem. At $1 trillion, you've got the world baked into these valuations. I think out of the money puts still make a lot of sense. This is a bellwether stock. This is the most important retail stock in the market, by the way.
Yeah.